Hi, this is Matthew Cratter from Trader University, and today I want to talk about how to trade call options. A lot of people make this more complicated than it needs to be, so I'm going to give you the really stripped down version. If you're interested in learning how to trade options or how to make money in a bull or bear market or really any environment, be sure to hit that subscribe button. So a call option, you basically buy a call option if you think a stock is going to go up. A call option gives you the right to buy 100 shares of stock. So one call option is basically equal to 100 shares of stock. And it gives you the right to buy those 100 shares of stock at a specific price, which is called the strike price, within a specific period of time. In other words, before the call option expires. So for a call option, you basically have the ticker, you have the stock, you've got a strike price, and you've got an expiration date. This will make a lot more sense when we look at an actual example. So I just went to Yahoo Finance. I typed in Coca-Cola. The ticker for Coke is KO. That's if you want to buy or sell the stock. And then if you just click right here where it says options, this will give you options data. So I'm going to go there right now. And we can see that there's a whole list. There's at the top, it says calls. These are call options, which I'm going to be talking about in this video. At the bottom are put options, which I'm going to talk about in tomorrow's video. There's also a drop-down menu here that has the different expiration dates. So today is currently May 24th, 2020. And here are all the different options we can trade, the different expiration dates. We can see there's one that expires in 5 days, and then one that expires in, 10 days, etc. All these different expirations. Now, options tend to lose a lot of money as you approach expiration. And so there's sort of a trade-off. If you buy an option that's very close to expiration, it will cost less money, but it will decay on you more quickly. In other words, it'll lose time value. So these are basically all the different expirations that we can trade. It's a little bit more of an art than a science picking which one, but I'm going to show you how I pick them in this video. So those are the expirations. And again, every option has an expiration date. And you want to exit an option maybe a couple days before it expires. And then we can see that we also have the strike price right here. As you can see here, it says strike. And Coke is currently trading at about 45. It closed at 45.03 per share on Friday. Now, if we scroll down here, we will see the different strike prices. So let's say we're going to go out about 10 days. Actually, we'll go out to the main expiration, which is the third week of the month. That's June 19th. And we'll look at the different strike prices. So Coke is at 45 roughly. And so we can see right here, we have the 45 strike expiring, as we said, June 19th. And then we have a bid and an ask. You could sell it for 109. You could buy it for 120. Last trade at 117. So in order to buy this option, it's trading for $1.17. Basically, there's a multiplier involved. So in your account, you're always going to want to multiply this by 100. And so in your account, you're going to need to have $117 in order to buy this call option at this price. Now let's talk. I need to give you one more piece of terminology so we can talk options. And again, when you're first starting with options, be easy, go easy on yourself. A lot of this terminology can be a little confusing, but it's not as bad as you think. Maybe watch this video a couple times. So again, we have call option, we have the strike price, we have the expiration date. Now I'm going to add just one more concept. And this is the concept of moneyness. You've probably heard of at the money options, out of the money options, in the money options. So let's say the Coke is trading at $45 a share. An at the money option, an at the money call or put, is when the strike price is right at the current stock price. So if Coke is trading at $45 a share, and we're looking at the 45 strike price, those would be considered at the money calls. Now we saw that Coke is actually trading at 45.03. It doesn't have to be precise, but if Coke is roughly around 45, you can say you're talking about the at the money calls. This is just the terminology that option traders use. Now an out of the money call has a strike price above the current stock price. The strike price is above the stock price. So if the stock is at 45, an out of the money call would be a 50 call. Actually, it would be the 46, the 47, the 48, the 49, the 50, anything above where the stock is currently trading. These are the most commonly traded options: at the money, out of the money. If you're speculating, you're probably going to be using slightly out of the money call options. In the money is when the strike price is below the current stock price. So if the stock is at 45 right now, an in the money call would be the 40 calls. We're not going to worry about in the money calls right now. I do talk more about them in my course if you're interested. So let's just jump right away to a trading example, because I think that people get hung up on the terminology and they worry about that much more than how you actually trade them. So I'm going to look at the stock FSLY, FSLY. We can see this is, I believe it's a fairly recent IPO from last year. From basically, it's about a year old, and it's been breaking new highs, which is quite interesting in this environment. Now, this chart I have this is a daily chart. These are daily candlesticks. I'm looking at the 50-day moving average, which is the blue line. So that's the line right here. I have the 200-day moving average, which is the red line right here. I'm using TradingView for this. It's fairly easy to set up. And what's interesting here is we can see that we just had a crossover. So this is a bullish signal for a stock when the blue line crosses above the red line. The 50-day moving average crosses above the 200-day moving average. And when the stock itself is trading above both the blue line and the red line, that's bullish. Now we just had a slightly bearish candlestick here, this last candlestick on Friday. It looks a little bit like a bearish engulfing candlestick. This is not as important as the underlying trend, which is as measured by the moving average lines. But just to let you know that this may be reversing, but I'm just using this as an example. It's not investment advice or anything like that. So we know that we want to buy. We think the stock is going to go up. We think FSLY is going to go up. We can either buy the stock, or maybe if we're trading a smaller account, we would like to trade options on it. So if we want to buy 100 shares of the stock right here, 100 shares will cost us 100 shares times the stock price, 41.08, and so that'll basically be $4,108 just to buy 100 shares of stock. Now, the nice thing about options is they give you leverage, which means you can make more money if the stock goes up. You also lose more money if the stock goes down. But I'm going to show you how to swing trade using call options here. So I'm going to go inside of Robinhood, and I just type in FSLY up here. I select it. It takes me here. You have to turn on options trading when you open up an account with them. I think you have to fill out some extra forms. I did this a long time ago. But then you basically, you can click on the options trading tab, and you'll be taken right here. Again, just like in Yahoo, we can see that there are a bunch of different expirations here. We can also see that you have a choice of buying calls, buying puts, selling calls, selling puts. I really like their interface. They make it really intuitive. But we're going to be buying a call in this case. And we can see that this is FSLY. They put the stock price right in the middle here. So you can see that it closed at 42 on Friday. And then, as we said, there's the drop-down list here of expirations. And then on the left here, on the left side, we have the strike prices. So the stock is currently at 42, or it closed at 42. We can see here the strike price, the 42 strike price. That would be at the money, because it's right. The strike price is equal to the stock price. And then we have the out of the money calls, which are, if I scroll up here, let me close this, there'll be all of these. And so it's one way to visualize this on Robinhood is any strike price, if the stock is right down here, let me just make sure you can see what I'm doing. So if the stock price is right here, these will be the out of the money calls. And anything down here will be the in the money calls. And then if the call's right at the stock price, that will be the at the money call. So let's look at what the trade-offs are here. We can pick an option, the nearest term expiration, it's expiring May 29th. And we can see that you can buy these at the money calls, which are the 42 strike, at roughly $1.25. Now, if we go out another expiration, it buys us a little more time, but the options get more expensive because you're paying basically for the time you're in the option. So instead of being $1.25 per option, it's going to be $2.20. If we want a couple months, let's say we want to go out to call it July 17th, those same at the money calls are going to be $4.85. So they're going to be more expensive. Now, the options that are very close to expiration will lose their value very quickly. The good news is the most they can do is go to zero. So if you buy this for $1.25, if you buy the at the money call, the 42 call for $1.25, basically there's a multiplier. So we take $1.25 times, if we're going to buy one call option, so we'll just say times one call option times the multiplier, because each call option controls 100 shares. And so one call option, we've multiplied this all out, one call option will cost us $125. Now the good news about being long a call option, buying a call option, is this is the most you can lose. The most this can happen, this could go to zero. And so in the previous case, we were talking about to control 100 shares, it would cost us $4,108. In this case, controlling 100 shares costs us only $125. Now, in the first case, the stock would have to go all the way to zero from 42 to lose this amount. Whereas with options, it's very easy to lose this $125. But it's nice, especially if you're trading a smaller account. So what we're going to do is we're going to look at the really close. We're expecting to just hold this trade for a day or two. We know the stock's in an uptrend. We saw that here because it's traded above the 50 and 200-day moving average, and we've had this bullish crossover. So we don't want to spend very much money on call options. So we're going to look at the nearest expiration, the May 29. We are going to look at the money calls. So the stock's at 42. We are going to look at the 42 calls expiring May 29th. And we're going to see that let's just assume we can buy them for $1.25. I don't know where these are going to open on Tuesday when the market opens back up. So the thing about options where people get confused is you don't need to exercise them. You can just trade the options themselves. And so if I buy this at $1.25 and the stock goes up and the option goes to, let's say it goes to $2.25, 225 minus 125 is 1 point. 1 point times 100 is $100. So if the option goes from 125 to 225, I will make $100, which isn't a bad investment. I mean, not a bad return on investment, because as we said, we're only investing $125. And so we've made almost 100% on our money. 125, we make a profit of about 100, close to a little less than 100%. 100% return on, call it return on investment. Now, what would be required for the option to move from 125 to 225? Well, if we want to look at it from the perspective of at expiration, or very close to expiration, in order to break even on this trade, because it is a 42 strike price, we would need the stock to go from where it is right now at 42, and we would need to cover our entire capital outlay of $1.25 or $125. And so what that means is, in order to break even on a very fast move, not taking into account time decay, implied volatility, there are a lot of very confusing things. I'm trying to keep this really, really simple. Our break-even price on this would be at 43.25. Now this is at expiration. If the stock moves quickly, we won't need this to happen. But basically, if we hold until maybe the day before this option expires, we need the stock to move up to at least 43.25. We can see right now it's at, this says it's at 41.08. I'm not sure this discrepancy here. This may be an after hours trade. But let's say the stock is at 42 right now. People always ask me about, should I buy a call option on this or that? And the only way to make money on a call option is you have to have a different view than the market has. And you have to be right about that view. So what this market is pricing in right now, it's pricing in that the options market thinks there's a decent chance that the stock can go up to 43.25 before May 29th. This is a fairly volatile stock. And so that's what's being priced in. So if you think that the stock can go above 43.25 before May 29th, maybe you think, you can see that here we've just in a couple days, we've moved from, call it 35, and we touch 45. This thing can move 10 points fairly easily within a couple of days. And so we definitely have a chance, especially if the market opens up bullish, the general stock market opens up on Tuesday, we would expect FSLY to move up as well. But that's one way to think of it. You need the stock to move up more than the price of the option. So what's basically, there are going to be two different factors at work. It's a little bit like It's a little bit like, let's say you have a river that's flowing this way, and you want to swim upstream. Well, the river that's flowing downstream is these call options losing money over time. So this option will expire. It'll be, if the stock is at 42 or below, it's going to go to zero on May 29th, or maybe even a little bit before, or it's going to get very close to zero. And so it's a little bit like holding an ice cube in your hand or swimming upstream. The option's going to be losing value over time. And what you need to happen is you need the stock to move up faster than the option is decaying. So the river's flowing downstream, you're swimming upstream. I'm sort of mixing my metaphors here with ice and swimming, but basically you need to swim upstream faster than the river is pushing you downstream. If these two completely offset each other, maybe the stock slowly moves up to 43.25, you won't make any money because it'll get there right as the option's about to expire. And so what you really need is you need explosive stocks where that explosiveness is not being priced into the option itself. So in this case, if you're buying a call option, you want the stock to be in an uptrend. And if the stock decides to just kind of go sideways here, sort of chop around for 5 days, your option will lose money. But if it really breaks to new highs, this could easily move up to, can move up to 50. Let's say it moves up to 50 at expiration. So we own the 42 strike price. And let's say the stock moves up to 50 right at expiration. Let's say a day before expiration. Well, in that case, the value of this option will just be equal to the stock price minus the strike. So it will be equal to 8 if you get that fast move. And again, it has to do this before May 29th. Now, how much did we pay for it? Well, we only paid $1.25. And at expiration, if the stock is at 50, when there's no time value left, we haven't talked about time value, but basically our call option, which we paid $1.25 for, will be it will only have its intrinsic value, its in the money value, which will be $8. And so the call option will move from $1.25 to $8. And you can see this is like making more than 4x on your money. And this is why options have so much power. But you have to be very careful because you can also obviously completely lose your initial investment. So the best way to learn about options is to trade them using very, very small amounts of money and just kind of get a feel for how this works, see how they trade in real time. Now, again, you don't need to exercise these options. You just trade the underlying options. So if I wanted to trade this, I would just basically hit the plus sign here. And if I had $125 in my account, you can see right now I only have 42 cents cash available because the account is fully invested with other things, including my Tesla shares and some other the gold royalty stocks. But basically, you need $125 in your account. This is Robinhood doesn't charge commission, so that's all you need. And if you were able to get executed that price, then you would you just hit this plus sign. You enter a market or limit order, and you're off to go. And you never need to exercise the call option or do anything like that. I hope this has given you a feel for how call options work. There's a lot to cover, and I've tried to cram it all into an introductory lecture. If you want to go a little more in depth, you can check out my online courses. You can click the link in the description notes below, and especially learn to trade options like a pro. I must have 30 or 40 lectures in there. Swing trading with options goes into this in a lot more depth. You can a membership to Trader University gets you access to all of these different courses. Learn to trade stocks like a pro, bear market trading strategies, crypto and Bitcoin, even financial statement analysis, some real estate courses, etc. So if there's something that interests you, you can just click on the description notes below, and you can see all the lectures. You can click on any of these boxes. It'll show you all the individual lectures inside of each course. Now, normally, monthly tuition is just $125. That gets you 30 days access. But I want to give you a special coupon code. So you go to this page, you click Get It Now. That'll take you to the checkout page. And I'm going to give you a coupon code right here. So where it says have a coupon code, you just type in YT, as in YouTube, 99. Click Update, and that'll lower the price from $125 for 30 days access to just $99 for 30 days access. That gets you access to all 13 courses. You can watch them all and cancel before your subscription renews. You won't be charged again. There are no long-term contracts or anything like that. So if you're still stuck at home in quarantine, you're tired of watching Netflix, and you think this is a good time to maybe learn how to trade options or how to trade futures or how to trade stocks, you can check out my paid courses. Hope you guys found this helpful. If you did, please hit the subscribe and like button, and let me know your questions and comments in the comment section below. Thanks a lot for listening. Hope you're all staying well, and I'll see you in the next video.